Something strange is happening with Bitcoin. The cryptocurrency that once seemed unstoppable is now facing an unprecedented crisis. For years, investors followed a predictable calendar, a rhythm that seemed guaranteed to make money. The cycles were almost like clockwork, giving traders a sense of security. But in the last few months, that calendar has been torn to shreds. The once reliable patterns have disintegrated, leaving investors scrambling. Bitcoin just did something that sent a shockwave through the crypto world. After a massive run-up, it suddenly dipped below the crucial $100,000 level. This was a psychological barrier that many believed would hold. All the gains from 2025 were wiped out in a flash. The rapid decline has left even seasoned investors in disbelief. This wasn't supposed to happen. Not now. Not like this. The market was supposed to be in a bullish phase, riding high on optimism. The old rules said the party should just be getting started. Instead, we're seeing fear. Investors who were celebrating just weeks ago are now in a state of panic. The charts are flashing warning signs we haven't seen in years. A dreaded pattern called the death cross just appeared. This is a bearish signal that has historically preceded major downturns. It's a technical signal that often comes before a major crash, like a check engine light blinking furiously on the freeway. Traders are now on high alert. The market's mood has turned ice cold overnight. What was once a hotbed of activity is now eerily quiet. Big money is running for the exits. Institutional investors who once propped up the market are now pulling out. For 3 weeks straight, more money has been pulled out of crypto funds than put in. This exodus is unprecedented and alarming. These are large funds and institutions, not just small-time investors. Their exit signals a lack of confidence in the market's future. Their sudden departure has left a giant hole, making experts nervous. The market is now struggling to find its footing. The confidence that defined the market just months ago has evaporated. Investors are now questioning the very fundamentals of Bitcoin. This isn't just a small correction, it feels like a fundamental shift in how Bitcoin behaves. The volatility is unlike anything we've seen before. The old playbook is out the window. Strategies that once worked are now obsolete. Top experts warn the most reliable pattern in Bitcoin's history is broken. The predictable cycles that traders relied on are no longer valid. The era of easy, predictable gains may be over for good. The future of Bitcoin is now more uncertain than ever. To understand the panic that gripped the market, you first need to know about the old rulebook, the legendary 4-year cycle that shaped Bitcoin's history. For more than a decade, Bitcoin's price moved in a surprisingly predictable rhythm, almost like clockwork, all tied to a unique event called the halving. This event was the heartbeat of the entire crypto market, and everyone watched it closely. Every 4 years, the reward for mining new Bitcoin is cut in half, instantly slowing the creation of new coins. This wasn't just a technical tweak, it was a deliberate design to make Bitcoin more scarce over time. This sudden supply shock made existing Bitcoin more scarce and, in theory, more valuable. It was like finding out there's less gold in the world than everyone thought. The halving acted like a starting gun for a massive bull market, setting off a chain reaction of excitement and speculation. The pattern was simple but powerful: halving, explosive bull run, brutal bear market, then a long, quiet period of accumulation. This cycle repeated itself with almost uncanny precision year after year. Investors used this cycle as a map, timing their moves, buying big during the accumulation phase and selling near the euphoric peak, hoping to maximize their gains. It took much of the guesswork out of a notoriously volatile asset, giving traders a sense of control in an unpredictable world. Following the cycle felt almost like having a cheat code for the market, an edge that others didn't have. This sense of predictability made Bitcoin wildly popular. It wasn't just chaos, there was a method to the madness, a logic that anyone could follow. The halving created a supply squeeze, and human psychology, greed, fear, and hope did the rest, fueling the cycle. FOMO would kick in after each halving, pulling in waves of new buyers and pushing prices to parabolic heights as everyone rushed to get in. Then, after the peak, came the inevitable panic selling and a dramatic crash, wiping out fortunes in a matter of weeks or months. It was a simple, almost foolproof model for those who followed it closely. But as we'll see, that certainty didn't last forever. The 4-year cycle wasn't just a theory, it was a pattern that played out in real time, over and over again, almost like clockwork. For years, it was the closest thing to a guarantee in the wild world of crypto. After the 2012 halving, Bitcoin soared from just $12 to over $1,100, capturing headlines and imaginations worldwide, before crashing back down to $200, leaving many stunned. The 2016 halving brought another epic run. Prices climbed from the low hundreds to nearly $20,000 by late 2017, only to tumble all the way down to $3,000 in the brutal bear market that followed. The 2020 halving, same story, but on an even bigger scale. Bitcoin rocketed from $9,000 to a jaw-dropping $69,000 in 2021, then crashed to $16,000, shaking the faith of even the most seasoned investors. 3 halvings, 3 massive bull runs, 3 devastating crashes. The pattern was so consistent, it felt almost inevitable. This track record built a near-religious confidence among investors and traders who saw the cycle as a guiding light in an unpredictable market. Analysts created models like stock-to-flow, projecting future prices into the hundreds of thousands, and these models became gospel for many in the space. The entire industry, traders, funds, even casual investors, structured their strategies around this 4-year timeline, planning moves years in advance. The expectation for the post-2024 halving was for an even bigger explosion, $150,000, $200,000, or more. Hype and hope reached new heights, but that's when the story started to change. The market began to behave differently, and cracks appeared in the once reliable pattern. The cycle's reliability had made it the one constant in a chaotic market, a rare anchor for those seeking order in the storm. Investors believed they could set their watches by it, timing their entries and exits with near-mechanical precision. But now the pattern is breaking down. The signals that once seemed so clear are starting to blur. The market is no longer following the script. Volatility and uncertainty have returned with a vengeance. The old certainty is gone, and investors are left wondering if the clockwork cycle has finally run out of time. The current cycle, starting after the April 2024 halving, looked normal at first. Bitcoin broke its old all-time high before the halving. A first, but the explosive rally that was supposed to follow never materialized. Instead, the price chopped around, with sharp moves in both directions. A new peak in October 2025 at $126,000 was quickly met with a 21% correction. The smooth upward trajectory of past cycles was replaced by a jagged, uncertain mess. On-chain indicators that once signaled overheated markets stayed quiet, even at new highs. This suggests either more room to run, or that the indicators themselves are now unreliable. The recent plunge below $100,000 and the death cross are the biggest cracks yet. The map everyone was using is leading them off a cliff, and panic is palpable. What broke the cycle? The arrival of Wall Street. In early 2024, the US approved spot Bitcoin ETFs, letting anyone buy Bitcoin like a stock. Giants like BlackRock and Fidelity launched their own ETFs, vacuuming up over $64 billion in Bitcoin. This demand front-ran the halving, pulling the bull market forward. But ETF inflows are a double-edged sword. When sentiment turns, outflows can be brutal. Recently, $660 million was pulled out in just 6 days. These big players aren't long-term hodlers. They react to macro data and risk. Their presence ties Bitcoin to the traditional financial world. Now Bitcoin's price is subject to the same forces as stocks and commodities. The simple, self-contained 4-year cycle couldn't survive this transition. The market is fundamentally different. The old rules no longer apply. If anyone was the high priest of the 4-year cycle, it was Michael Saylor. As CEO of MicroStrategy, he bet his company on Bitcoin, but even Saylor now says the 4-year cycle is dead. The halving supply shock is now just a drop in the ocean compared to ETF flows. Daily trading volumes from institutions dwarf the impact of the halving. The market is now driven by mega finance actors, not miners and retail. Relying on the old pattern is, in Saylor's view, a recipe for disaster. He's even structured his company to survive a 90% crash. The captain of the biggest Bitcoin ship is preparing for hurricane force winds. When the ultimate bull says it's time to be cautious, you should listen. While Saylor declared the cycle dead, veteran trader Peter Brandt offered an even starker warning. In October 2025, as Bitcoin hit $126,270, Brandt pointed to a bearish, broadening top pattern. This often signals the end of a bull run and the start of a major decline. Brandt warned the October peak might be the high for this entire cycle. The ETF inflows may have pulled the cycle forward and ended it early. The sharp rejection from the October high fits Brandt's scenario perfectly. The market is behaving as if a major top is already in. While many dreamed of $200,000 Bitcoin, the party may have ended while no one was looking. Not everyone has given up hope. Some analysts argue this is just a mid-cycle consolidation, a long, choppy pause before the next leg up. They point to quiet on-chain indicators as evidence the true top hasn't arrived. Some, like Plan B, suggest the cycle is lengthening, with a peak possibly years away. But these voices are now in the minority. The overwhelming consensus is that the old patterns are broken. Relying on hope is looking riskier by the day. The 4-year cycle is dead. The easy map to crypto riches is gone. You can't just buy after a halving and wait to get rich. The market is now more sophisticated, and so must you be. Institutional flows, Fed policy, and global economics now drive Bitcoin. You need to understand the broader economy, not just crypto news. The buy and hold for the cycle approach is now risky. Dollar cost averaging is a smarter strategy to manage volatility. The days of guaranteed 10x gains may be over. Bitcoin is now a mature, global asset class. This brings legitimacy, but also strips away the simple, explosive predictability of its youth. The training wheels are off. For those who adapt and stay cautious, opportunities remain, but don't expect it to be easy.